Welcome everyone. Welcome to our webinar. Thank you for joining us. We got lots of good information tonight. The main focus is going to be tax, how to reduce tax in retirement. I mean, quite often folks don't think about it, but normally the largest expense in retirement is tax. And that's the goal of tonight's presentation, how to cut that down. So there's less money in the government's pocket, more money in your pocket. Later in the presentation, we'll bring in Adam Buss, our wealth and estate planning specialist, to go through a couple of strategies on how to cut down that tax bill. So definitely going to have some good information. And the goal tonight is to ensure everyone gets some information they find of value. We believe a great way to do that is through questions, participation. We'll have lots of slides, lots of information, but if you have a question, chat it into the comment box, whether you're on YouTube or on Facebook. We can see those. Some of them we might pull onto the screen if it's a larger topic that applies to maybe a few more people, or even if it doesn't, we'll reply to you in the chat window, just so that way you'll still get some information, and we'll try to make sure everyone will leave with some data they find of value. And tonight's agenda, Kevin and I will start off with a market update. We're going to talk about what happened 2020, 2021, this COVID pandemic, certainly some interesting times in the market. Kevin and I will go through that. We'll try to keep it brief so we don't spend too much time there and leave lots of time for Adam, our wealth and estate planning specialist, so he can go through all those tax tips. But a quick starting point, Kevin, why don't you remind folks of the company involved?
Yeah, exactly. So Clint and Kevin, they're both portfolio managers and investment advisors of Becker Wealth Management, and we do work for Canaccord Genuity Wealth Management. We are the largest independent investment firm in Canada, and we do manage roughly $95 billion of clients' assets globally. We have offices across the country. We also have offices in the UK as well as Australia, and a few offices in the United States. Now, again, we are a member of what's known as CIPF, or the Canadian Investors Protection Fund. That guarantees protects your accounts in the assets that are there. It is the same protection that they use at the big financial firms. But it's not just you and I, Clint, is it? There's more to us.
There is, absolutely. It is a full team effort. We'll show some of the team members here. You can see all of us in the photo. These are the full-time members, myself, Kevin, you see Adam in the middle, and then Markar and Alicia. There are part-time staff in addition to that help out. And our goal as a team, of course, is to tackle for each and every client our promise, commitment, clarity, and confidence. For us, commitment, it's all about communication. Things change. They change in the financial world. They're going to change in your lives. We got to make sure those lines of communication are open so we can address those changes. And if we do our job there, should lead to clarity. Clarity in the goals, clarity in the objectives, high level commitment, high level of clarity. The end result is confidence. Confidence in our team, in our process. Most importantly, we want you to have some peace of mind and confidence in your financial plan. I mentioned our process. I'll quickly touch on it here. I know it's quirky, but we call it financial architecture. The idea is that if you're going to be building a house, you can't just zoom in on one piece of that house. Can't just get focused solely on the kitchen. You got to make sure everything else comes together. Same thing in the financial world. We want to make sure there's a strong foundation. That's likely going to be your estate, your life insurance needs. Then we worry about the frame. What we talk about there is often planning, tax planning, retirement planning, what we'll go over tonight. And then what we do there will influence the interior, which are the investments. So we'll touch on a few of those throughout the evening. We'll do a quick market update like I talked about. A reminder for those of you just joining now, Kevin and I will do a brief market update. Then we'll hand things over to Adam Buss. He'll have lots of time to go through all those tax tips and strategies to reduce tax in retirement. But briefly, let's touch on the markets here. Kevin, tell us what happened.
Yeah, basically, before we can start going to see where we think we're going to go forward, we have to look at what has happened over the course of this year. And we can go back over this year, and basically we've seen the chart here in front of us, goes from sort of October straight through until the middle of September, where we are right now. But we really want to take a look at 2021. And if we notice, 2021 has been a very good year for the North American market so far. It's an upward trend that we've been seeing going on since roughly November of 2020, as the chart shows. And of course, the reason that happened was there was two significant incidents that happened back in November. First, what we saw was a new administration coming into the United States, which the global economies tended to like. And second, and probably more important, Moderna and Pfizer came out with proven vaccines for the COVID-19 that has been running rampant across the world for a while. But another anomaly that we probably don't notice here, or you can see in the chart, is we have not experienced a 5% pullback this year at all. That is very rare. Over the course of a year, you probably see a couple of them, even on an upward trend, but so far we haven't seen that at all. Now, similar patterns are happening in Canada as they are on the S&P 500 here that we're showing. And again, markets have been really resistant, and a lot of this is based on a few different scenarios. First, we've had a lot of fiscal and monetary stimulus, not only in North America, but globally. So a lot of money flowing in to people and a lot of money flowing into the markets. We're also having what's known as a fear of missing out. People see what's going on, they jump in because they don't want to miss what's there. It leads to what's known as a buying the dip mantra. So every time the markets come down, people jump in because they see it as a good time. That, coupled with things along the lines of low interest rates that we're seeing historically, means that fixed income isn't paying as much, and the economy reopening as we're starting to see COVID dissipate, or at least we're getting more vaccine out there. But again, this is what's happened so far. Beyond that, there are historical times that this non-5% has happened beforehand, hasn't it, Clint?
Yeah, it's not the first time we've had a market this calm. I see more and more folks are joining the webinar, which is fantastic. For those of you who are just joining, a reminder, Kevin and I will do a quick market update. Then we'll bring Adam Buss in to do the keynote presentation to talk about taxes, talk about ways to reduce taxes in retirement. Kevin, you just mentioned the volatility, particularly that the stock market so far 2021 has not seen a 5% pullback from January 1st until the end of August, that 8-month window, not one 5% pullback. That is unusual. Most years there's 2 or 3 of those. Often there's even a larger 10% correction. Those are common in the stock market. Not the case so far in 2021. What you see on the screen here is data from Seth Golden. He looked at Bank of America research as well as Bloomberg to create this table. And lots of data, but I'll focus our attention. What he looked at was the period from January to August, and he looked at the prior 13 times that you had markets this calm, where there wasn't even a 5% pullback. It happened 13 times before, and what he found is in the September through December period, so right here, that column, after that very calm stretch, first calm 8 months, the other 13 times this happened, you did get a pullback in the remaining 4 months of the year. Depending on the year, you can see different sizes of pullbacks, but across the board, there is a pullback in each and every one. And you could argue that what we went through so far in September with that turbulence, maybe that is the pullback. But more important is this column right here, that September through December return. Again, we're looking at the 13 prior times. We had very calm markets for the first 8 months of the year. And of those 13, 100% of the time, the last 4 months of the year were positive. Every single time that September through December window, you saw more growth. 100% of the time. So history does not always repeat itself, but it does give us a little bit of confidence going forward that we could see a repeat in 2021. But let's dive a little deeper here, Kevin. Let's look into a few of the individual pieces here that could make up that rally.
Yeah, exactly. And as you said, we've seen nothing for 5%. We could possibly have it over the next 4 months at some time. Traditionally, that happens, and we could see where it goes from there. But this chart in front of us, it's an all-stars chart that came up. And basically what we're doing is we're comparing commodities, which are a very important part of any market recovery or market substance going forward, compared to what the overall stock market has done. So if we take a look sort of at this chart from 2000 to 2010, that downward slide, that is the stock market as a whole. Now, that doesn't mean the stock market came down. It just means that commodities did much better than the stock market as a whole in that 10-year time span. And again, a lot of this has to do with the fact that in 2000, we had the tech wreck recession. And of course, coming out of that, you're going to need materials to rebuild the economy. In 2008, we had the Great Recession. So again, it's another one of those scenarios where coming out of it, you're needing materials, oil, gas, everything else to build going forward to make sure that the economy starts running around. But if we take a look at that time frame from 2010 up to 2020, where the crude oil futures trade below zero, we see that the market vastly outperformed what commodities did at that time. The market had a nice 10-year bull run. And what we should mention is that trading below zero, that is the first time in history that oil in North America has ever traded below zero, and it was a trigger point. After that, as we can see, the commodities have been outperforming what the stock market as a whole has been doing, and we've been seeing that trend ever since then. That's one of the important things that we should note. And again, we're moving into an economy still reopening, so you need a lot of different materials to go forward with it. How long this is going to continue at this point, we're not sure, but the balance of the reopening continuing to go on, we see that happening. But But again, commodities aren't the only part that we want to deal with. There are things along the lines of inflation we have to worry about, isn't there, Clint?
Absolutely. It's all part of a larger trend. The economy reopening, all that stimulus, commodities tend to do very well in that kind of environment. But anyone that has gone to the grocery store lately can tell you prices have gone up. Normally, when the economy starts heating up, you see some inflation. We've seen higher inflation because we're coming out of a pandemic. And normally, how do central banks deal with inflation? They raise interest rates. And that's what this chart is all about. It's from Charlie Biello at the Compound. He looks at central banks around the world and has an idea of what their last move was. This is the column right here, the column we're looking at. And if the last move was a cut, meaning they cut rates, it's green. If the last move was an increase in interest rates, they label that as a hike. It's highlighted here in red. And in 2020, COVID hit around the world. Central banks cut rates. That was the trend. And in 2021, in the latter part of 2020, we started to see that trend start to change. Certainly outside of North America, you can see there's many other central banks outside of North America that have been hiking their rates. We can actually add Norway to that list. Just today, they increased their interest rates. So they're now part of that same trend of raising rates to fight inflation. We have not seen that yet in North America. What we have seen is that the central banks have said, we'll leave rates alone for now, we'll keep them low, but we're going to start taking our foot off the gas pedal in terms of stimulus, what they call tapering. So maybe not quite as much stimulus going forward. They'll leave rates low for now. But again, the trend outside of North America seems to be tilting towards increasing rates. So eventually we could see that in North America as well. Let's finish up the piece here, Kevin. Where are we headed when it comes to the markets and the economy?
Yeah, we've basically covered where we've gone from January up till now. Now we want to find out where we're going to go for the rest of the year and moving on beyond that. So as we see in the first part, we're dealing with that stimulus. You just mentioned that we're putting the brakes on a little bit. We're taking the foot off the gas, but there's still stimulus out there. Governments are still supplying money in the quantitative easing side. They're still keeping interest rates low. So they still want to make sure that stimulus while there's some COVID out there. And until COVID dissipates, I think we're going to continue to see this. The US came out and basically said they're not going to look at doing a whole bunch of tapering until starting November. And then we have to see what it looks like from there. But also we have to look at the inflation factors. You've mentioned inflation. People are starting to get that hike. Why? Well, traditionally we've had inflation at about 2%. Right now we're in that 4 to 5% range. Most analysts and economists believe that this is transitory. The governors of the banks and the central banks believe the same thing. If it is transitory, like they say, it'll come back to that 2%. The economy should still continue to move going forward. That, you couple that all up with the fact that we are getting a reopening because COVID is starting to dissipate a bit, and we are starting to see that, yes, economic growth will still continue moving forward. We're probably in the middle of the recent bull market that we're in, so we're not forecasting anything to come down, but by the same token, we think that it's going to move up, maybe at a slower pace than it has over the last little while, but still on that upward trend. But again, that's not everything. There could be things that change our mind, isn't there, Clint?
Always. Yeah, as much of it, we like to have the data to support the thesis. Market doesn't care what we think. It can do something completely different. So Kevin kind of laid out the thesis there, the commodity bull run, the idea we could be kind of midway through an overall bull market when it comes to the stock market. But there are a couple of items we're going to have to watch that could tell us when we're wrong, could tell us when we have to adjust our strategy. Top of the list there would be the US dollar. Often, if you have commodities doing well, the US dollar might be a little weaker. Commodities tend to be priced in US dollars, so if the US dollar is a little weaker, that means other countries could buy them at a cheaper price, so you could see an additional global demand, all factored into that commodity cycle as well. Kevin talked about inflation. It's already pretty high. We think it could be partly transitory, but if it's higher than we expected, or if it's not as transitory and it's more sticky, both of those items could give us an inclination that we got to change our strategy. We've got to adjust what's going on. And the last piece there, of course, has to do with COVID. If the variant continue to spread, and particularly North America, if the governments deal with that with additional lockdowns, well, that'll hurt the economy. That could change our tune when it comes to the markets. That's another item we've got to add to that watch list. I know we did that market update quickly, but we wanted to keep lots of time for Adam Buss to go through all the tax planning strategies. We'll just take a quick second here to see if there are any questions when it comes to the market, and then we'll bring Adam on to cover the retirement tax plans. Were there any initial questions? All right, nothing at the moment, but we'll stick around for a second here, let Adam get his presentation up and running, and then we'll transition into the tax planning strategies there. So for those of you just joining us, Kevin and I did a quick market update, and now Adam's getting everything all set up, and we'll jump into retirement and particularly tax minimization strategies. Let me know when you're ready there, Adam.
I believe I am ready to go whenever you are.
Alrighty. Boom. There we go. Look at that. So a reminder, you can ask questions by typing into the comment section. We will pull some of them up on the screen, and also there'll be some that we answer simply in the chat box. So please ask away. And Adam, we'll leave it to you. Walk us through.
Excellent. Thanks, Clinton. Thanks, Kevin. So again, as I mentioned, I'm Adam Buss, the Wealth and Estate Planning Specialist here on the team. So we are going to get into some tax strategies, save you some money in retirement time. But first, before we dive into the strategy side, we need to start with the building blocks of what we look at for different retirement income sources. So we'll cover some of these, a few of the basics, and then we'll kind of dive into the strategy section a little bit later on. So bear with me as we go through a couple of these items. So obviously one of the big ones that many people in Canada do rely on is the Canada Pension Plan. So generally the normal retirement age to start collecting this, as we'll call the 100% amount, would be at age 65. Now, everybody does get a different amount based on what you contributed throughout your working career to the Canada Pension Plan. The current maximum at age 65 would be about $1,200. However, the average Canadian's only getting roughly about half of that, as not everybody contributed the max throughout their working career. You can take it earlier if you would like to, but you would get a reduced amount for every month that you take it early, resulting in about 36% less if you would take it at age 60 versus at age 65. And of course, if you happen to want to defer it a little bit later on, you can push it all the way till age 70, in which case you'd get a bonus instead for every month that you would defer it out. So that's just a couple of the quick basics on that one. Of course, the Canada Pension Plan, just like most income sources you're going to get in retirement, is fully taxable. It is included as income in the year that you received it. So there's not too much getting around that one, but we can look at how all the income kind of ties together for some tax planning strategies, again, a little bit later on. Another one of the government benefits is old age security. So this is not based on how much you put in throughout your working career. This is funded out of general tax revenues. Everybody would potentially get the same amount starting at as early as age 65. We'll get to that on the next slide. But it is a couple different program parts that go along with it, which is the base old age security. There is a guaranteed income supplement for those that have a lower taxable income in retirement time. There's an allowance for pre-65, depending again on income levels. And of course, you can't take it prior to the age of 65, given the current environment. As for OES, again, it is taxable income. So just like the Canada Pension Plan, you are taxed on that every year as you do receive it. There are, tax-free amounts when it comes to the guaranteed income supplement and the allowance for survivors. So that is treated a little bit differently. We're not going to get into the weeds on that one today. It does go based on how long you have been in Canada, though. So that is the one requirement to determine how much benefit you would get. So it's basically 1/40th of the OAS amount for every year that you've been in Canada. So if you're born in Canada, been here since the age of 18, then you should get the maximum. For those who maybe came to Canada after they're 18, it does go based on how many years you were in the country to determine what your benefit would be. There is also something called a clawback or old age security recovery tax. So if you make too much money in retirement, the government can take part of this benefit away from you on an annual basis, prorated based on how much money you make. And it does start to get clawed back, taken away a little bit from you, starting at around $80,000 a year of income, and then fully taken away somewhere between $125,000, $130,000 a year. All those numbers do modify with inflation on an annual basis. And of course, we did mention that the standard old age security can be taken at age 65. Current amount is just under $630, but you can defer it out. So you do have the option to defer it all the way till age 70, and they do give you a deferral bonus for continuing to defer that benefit. Why would you do that? Well, perhaps you're still working, perhaps you're in a higher income bracket, Those would be two common ones that we'd see for clients. Maybe some clients that are still working at 65, they make too much money, they're going to get it all taken away from them anyways. They might want to consider deferring that benefit a year and then getting that deferral bonus instead of taking it early and having it all taken away due to the clawback. Then we look at some of the obvious ones as employment income. So there are a lot of Canadians that are still working beyond the age of 65. It's actually a bit of a surprising trend right now that around 20% of seniors are still working beyond the age of 65. Whether that's due to financial needs, whether that's because they want to continue, whether it's in a part-time or full-time basis. I don't know what the rationale is behind it, but it is an interesting trend. The definition of retirement has certainly changed in the last, I'm going to say 10, 20 years for sure, that, it's a bit more of an active, it's a social aspect to retirement. So some people are doing it just to, be out there and socialize with friends as well. Do you plan on working part-time in retirement? Some people even look at a career change in retirement. What do you want to do with your spare time? How does this impact your cash flow? I mean, we always want to look at what are all of your income sources in retirement and how do they all tie together to create that cash flow so we can try to manage the taxation along the way. There's no point in us saying you should take out, $100,000 out of your RSP when you're still working full time, but we didn't make sure that we factor that in. So these are all important things to have as part of the detailed holistic financial planning discussion. And of course, a big one is if you're still working, then your retirement assets might have some additional time to grow. For those that do retire on the early side, it does eat away at the resources, tend to be a little bit quicker versus trying to defer some of that out a little bit longer. Other sources. So if people are fortunate enough to have some sort of employer-sponsored, work-sponsored pension plan, so whether that's just a group RSP, also known potentially as a defined contribution pension plan, maybe you have a defined benefit pension plan, those would be two very impactful options that we want to factor into your retirement planning. Different ways that we can take income from those. We can have them as annuities, which is quite a standard way for defined benefit pension plan, or convert it to a life income fund, which is basically a locked-in version of a RIF, or what a locked-in RSP converts to when the time comes that we want to start drawing it down. These aren't things you need to have memorized. These are things that your advisor, Clinton and Kevin, can certainly look at and work with you on when that time comes to actually convert those assets to income. And all of these income sources, when you do start to draw on them, they are taxed as fully taxable income. So again, once we turn that tap on, any income that's coming out of that account on an annual basis is taxed as regular income. So certainly something we want to factor in when we're looking at tax saving strategies. Okay, personal sources as well. So beyond, what the government's going to provide you, maybe what you had through work, we certainly want to look at what did you put aside throughout your working career, your lifetime, to go towards your retirement. So some of the key ones that people are usually looking at is RSPs. You've had the benefit of tax deferred growth, the tax deduction when you contributed the funds. It's quite flexible. And of course, the money is now fully taxable when you go to start withdrawing it out. Tax-free savings account, great program, huge fan of it. Tax-free growth as well, very flexible on the withdrawals, and there's no tax when we go to take the money out. And the nice thing is we can always put the money back later on should we have some extra cash kicking around that we want to top off that account again. And then non-registered account, investment account is taxed yearly based on the type of income that is generated. So it depends if it's capital gains, dividends, interest income, foreign dividends, all kinds of different things that are all taxed slightly differently. But these are things that we do want to factor in when we're looking at the overall picture in retirement and trying to map out what your cash flow would look like. So those are all the basic blocks of kind of when we're looking at, tax strategies and mapping out your cash flow. We've recapped some of those. We'll look at a couple of the common strategies that we look at for clients. Obviously, we're not getting into any, corporate income, any corporate dividends, selling a business. There's a rental properties. All of that is, obviously plays a factor into many Canadians, retirement income, but we're not going to cover those things in depth today at all. So what are 4 common strategies that we look at? So one would be pension splitting or pension income splitting, Canada Pension Plan sharing, prescribed annuities, and of course withdrawal strategies. So we can have all this money put aside, but what order should we take it out, and how should that flow on an annual basis? And of course the key point up top is the tax man is always going to get paid. That is probably the most asked question, is how can I pay little to no tax? And the answer is usually, we're good. We're really good at trying to plan these things out and try to minimize tax, but trying to pay zero tax is quite challenging when it comes to doing the planning, as the tax man does always get their share of it. How the tax system works in Canada. So obviously, if we're trying to do some tax strategy planning, it's always good to know as to how the basics of the Canadian tax system works. So we are in a progressive tax system with different tiered rates, which means that certain incomes get taxed at certain rates. So in this example, this is just the federal rates. There are provincial rates on top of that, and each province also has their own tiers, just to further complicate things and give you a mess of numbers. I will go through one of the examples a little bit later on. But the combined rates between federal and provincial is what we pay every year as a Canadian. So in this example, if you earn $48,535 or less, it's taxed at 15%. Every dollar that you earn above that is taxed at the next level, but the first $48,535 is still taxed at that 15%. So it is progressive in that regard. So usually when we look at kind of the overall picture, we're trying to stick within certain tax brackets or minimize the effective rate of your taxation overall. The 3 Ds of tax planning. So deduct, obviously, work with a great tax professional that can ensure you're taking full advantage of all your deductions or credits that are available to reduce your taxable income on an annual basis. That same tax professional can help on dividing your tax liability by taking advantage of income splitting. So we'll certainly get to that strategy coming right up. And defer paying tax. So keep your money working for you longer. Utilize the RSP while it makes sense to do. But the big one in retirement is continuing to utilize that tax-free savings account and that tax-sheltered, tax-free growth on that account. It doesn't seem like a lot at $6,000 per year. We certainly didn't think much of it when it came out years ago at $5,000 a year, but the numbers add up quickly. And if we're deferring that money out as long as possible, the numbers can add up quite large by the time you reach life expectancy, potentially leaving a nice nest egg for the next generation, or just gives you some more fun money to spend in retirement time. When we look at pension splitting, so certain types of income are eligible to be split. What I mean by that is you can split it with your spouse or common law partner. So if I made, $60,000 a year on my pension, I could transfer $30,000 of that eligible pension to my spouse or partner in order for it to be taxed under their name. So that is $30,000 taxed in my name and $30,000 in my spouse or common law partner's name, thus hopefully dropping both of us a tax bracket and putting more money in our pocket versus the government's pocket. That's what it's all about. Give you some more fun money, some more travel money in retirement time. So certain income types do qualify for this. So definitely want to check with your advisor as to where you're drawing your income from. So prior to the age of 65, it is your defined benefit pension plan. So if you're fortunate enough to have a defined benefit pension plan from your employer, that would qualify for income splitting. All the other sources would kick in after age 65. So once you start drawing down from your RIFs, then that income would be considered eligible pension income and qualify for income splitting on the tax return. So nothing you need to do at source. You don't need to talk to your pension provider. You don't necessarily need to tell your advisor that you're splitting the income, though it's always good to keep them in the loop so they can give you the right advice. But it's basically just taking care of it on your tax return, which your tax professional should be looking after for you. So how does that actually look like in practice? Well, this next chart, if my mouse cooperates with me. There we go. Shows the impacts of income splitting. So we've made an assumption with some tax return, tax rates, using some Manitoba tax rates. So what is the actual savings? So if we look at, again, I just use a $60,000 example. So again, if I took that entire 60 under my name versus splitting it with my spouse or common law partner, there's a $4,000 difference in tax savings. I mean, I can have a heck of a lot more fun with $4,000 in my pocket versus CRA using it, that's for sure. And of course, the higher income we get, the more that result is magnified. And if we look at the far right example on your screen, $100,000 of taxable income, that's a $7,700 tax savings, not to mention now we're preventing old age security being clawed back and part of that benefit being taken away from the one individual who's earning that $100,000. So not only is there a tax savings, there's also keeping more of that old age security in your pocket, which should actually probably add another 3,000 would be my guess, just onto that savings overall by preventing that clawback from happening. So certainly can be quite powerful. So definitely and a very important strategy that we look at for clients and trying to optimize their cash flows. If somebody is wanting to draw down on income sources before the age of 65, Clinton and Kevin and myself, we'd certainly look at it and say, where does it make the most sense? Should we take it out of spouse A or spouse B RSP or RIF account? What makes the most sense as a couple to optimize the taxation? Then we'll move on to the next strategy. So before I go on, don't forget to submit your questions online. Clinton and Kevin are monitoring those. They'll jump in if there is any questions that we can answer for you, or we'll save some towards the end. They might answer them along the way here as we go along. So another strategy, so strategy number 2 is Canada Pension Plan Sharing. So this would be, through an assignment of basically your credits during the time frame that you were married. So we'll go through that on one of the next pages, but it's trying to equalize your Canada Pension Plan benefit. Often quite beneficial if one spouse has a higher Canada Pension Plan benefit than the other one. Maybe one stayed at home raising the kids, has less Canada Pension Plan benefit versus the one who is working out of the home. So that can be a good opportunity. So I'll go through an example on the next page here. But it's basically just another way of trying to equalize your incomes. So both spouses, first off, have to agree to sign their Canada Pension Plan. So they have to be on the same page in that decision, which hopefully they would be. Both spouses must be at least 60 years old and receiving Canada Pension Plan. So that's obviously key that both are already getting that benefit. There's obviously some very exciting government forms that have to be completed, as it'll be noted there on the screen for you. And it does go based on how long they live together, how long during the contributory period, how much of the benefit is basically attached to that qualifying period, whether as a spouse or as a common law partner, what is the definable time frame, and how much benefit could potentially be split. So I'll do a quick math example. Let's say one spouse has a $200 benefit on Canada Pension Plan and one has a $1,000 benefit. So basically, if they were married that entire time frame, they'd take half of the one, half of the other, put them together, and then each spouse is now getting, $600 instead, because there's $1,200 as a couple. They'll split that $600 each. Obviously, most people aren't married straight from day one when they start contributing to Canada Pension Plan. But if it is the case, it would be basically a half and half split from each other's Canada Pension Plan. So not necessarily that we see overly often, but it can be a nice way of splitting the income. And again, trying to drop both spouses into a lower tax bracket overall. The next strategy, I'm going to say, is a little less common these days as interest rates are on the lower side right now. This would be a prescribed annuity. So this is what you generally do with a non-registered account. So somebody who's maybe low risk tolerance, conservative investor, they want to have a guaranteed income source, but also manage the taxation along the way. So basically what they would do is buy an annuity with their cash. In exchange, they get a guaranteed payment from the insurance company for the rest of their life. Now that guaranteed payment, instead of having, an up and down every year as to what the taxation is from the taxable income, It levels it for the rest of their lifetime. So it splits that interest amount into equal amounts every year so that it's fairly consistent tax-wise for them moving forward. So that can be a good way of trying to manage the taxation on that non-registered account. Unfortunately, annuity rates are based rather heavily as to where the fixed rates are. So they are a little bit less attractive these days from an annuity standpoint for getting a good rate of return overall. However, for investors that are quite conservative, very risk averse, and they want to look at guaranteed options, that can be a great way to enhance their cash flow, while at least dipping into the principal as well along the way. So these are things that we can do at Canaccord Genuity through Clinton and Kevin. Just let us know. Happy to explore some options with you. All right. And then the last strategy that we're going to get to, this one is a little bit longer. First of all, there is no one size fits all. So when we're talking about a withdrawal strategy, we are looking at what is the most logical order to draw down my assets in retirement. I've saved money in all these different pots, the tax-free savings account, the RSP, my work plan, non-registered accounts. How should I draw it down? What makes the most sense? How am I going to pay the least amount of tax? Okay. Probably my favorite response as a financial planner, which is definitely not helpful whatsoever, is it depends. As it depends on your situation, on your assets, what you need for cash flow. I mean, that's obviously rather crucial. And what tax bracket can we manage to stick you in? So these are all different things. Everybody's got different resources to pull from. Everybody's got different lifestyle needs. So we certainly want to take the customized approach and look at your unique situation and come up with the right strategy that fits your situation. So probably one of the most talked about sections when it comes to financial planning strategies, especially when I meet with clients, is definitely this one, trying to figure out where's the best place to draw the money from, which tax bracket we should try to get them to stick within. Ideally we'd coordinate with their tax professional as well, just to kind of look at the overall tax picture, see if there's anything that we're missing, so that they're getting the best holistic advice from all their team members. So what order should you draw down or access your retirement nest egg? Should you convert your RSPs to a RIF prior to age 71? That one's quite big. I usually believe that for most people, again, depending on when they retire, if we have time on our side to draw down those RSPs, why push it out all the way to 71 when we can start taking it out a little bit earlier and be in the driver's seat as to how much tax we're going to pay versus being forced later on to take out more than necessary and maybe get bumped into a higher tax bracket. We also know today that maybe both spouses are around. We can take advantage of income splitting and splitting that amount between two spouses when we're looking at tax planning and income splitting, as we chatted about earlier. So great to take advantage of that. Should you take money first from your RSP or the money from your corporation? So certainly one that we would map out for clients. I'm not going to go overly in depth on that one, but usually we're taking the money from the RSP first. And a big one is, what tax bracket are you in now and how might that change in retirement time? So obviously one of the golden rules when it comes to even putting money aside in the RSP is, put money in when you're at a high tax bracket, take it out when you're at a low tax bracket, and then you're getting a good tax rate arbitrage along the way. So certainly part of our comprehensive analysis, we want to determine what is the most tax efficient way to access these funds year over year, and kind of look at the customized approach and make sure that we're filtering money along the way to the tax-free savings account. So I did mention earlier that we went through some of the federal tax brackets. This is the ones for Manitoba. So those who aren't in Manitoba, your province would have a similar chart that would look like this, looking at what your marginal tax rates are for various income levels. So we certainly use this as as a tool to try to figure out where's the most logical place that we can, keep a client so that they're paying a controlled tax rate on their income sources without bumping them ideally into the next higher tax bracket. And of course, keeping in mind that we want to prevent getting old age security taken away from them as well. So how does that actually work in practice? Well, let's go through one of the examples. So let's say a client has a taxable income of $67,000 a year. And annual income level will be likely consistent year after year. Now that's important because if we're going to try to map this out, if there's going to be big fluctuations along the way, that might impact as to what we're recommending for a strategy. Maybe next year they're going to take up a part-time job, and that's going to change the income level. So those are things that are important to know to give the right advice. So the question is, does it make sense to draw additional money down from the RSP? So if the tax bracket in Manitoba goes from 49,000 to just under 73,000, and you're getting taxed at the same percentage, we would consider that it might make sense to take some additional cash out. And like I said, you get control of what tax level you're going to pay. I mean, yes, nobody likes paying any tax probably to begin with, but at least here you are taking it out when you know you're going to pay 33.25%. So you can take out the additional, 58.85 of taxable income, take that out, pay tax on it. If you don't necessarily need the cash, well, you could put it aside and do something else with it. If you're married or have a common law partner, and let's say you both have that same income level, that means you could double the amount that you're taking out because it just be split hopefully on the tax return. And then now you get that much more out of the RSPs and prevent maybe a large estate tax bill for down the road and items like that. Well, let's look at the next slide and look at a couple more things on this. So again, if you draw down the money, you don't need the extra cash. Well, let's look at, okay, let's put it aside into the tax-free savings account. Let's put it aside into a tax-exempt whole life policy to optimize your taxation. Or we can, again, put it aside into a non-registered account, all sources that are helping to grow the wealth, but at least taking it out of that lump sum taxable RSP account. Let's say you decide to defer the withdrawals a couple extra. You can say, you know what, I'll wait till 71. I'll wait till I have to start taking it out. Well, what if those RIF minimums now force you into a higher tax bracket and now you're paying, 4 or 5% more, plus potentially getting some of your old age security taken away from you? Worse, what happens if one spouse passes away? Well, now you can no longer split that income. So you have to take out a higher amount as an individual because you can't split that as a couple. Now maybe you're paying 10% more in tax and you're definitely getting old age security taken away from you. Not to mention, you've lost an old age security because your spouse or common law partner passed away. And of course, the eventual scenario is both pass away, but if you have still too much money in the RSPs, you might be taxed at the highest marginal tax rate because all of that money is taxed as if you earned it all on the last day that you're alive. And unfortunately, that generally pushes most people into the highest tax bracket and leaves a rather hefty tax bill. So again, wouldn't you rather be in control of how much taxes you pay? I think it's always nice to be in the driver's seat, but we'll let you decide that one. So let's look at another example of this. So let's meet Robert and Betty Sample, both age 60, retired at the end of 2020. So they are both fortunate enough. So together they have $62,000 of pensions. They have some RSPs. They have some tax-free savings. They have some non-registered money. And of course, they both qualify for Old Age Security in Canada pension plan. They tell us in our discovery meeting that they need about $6,000 after tax every month to live off of. So $6,000 put into their bank account every month to live off of. So they need additionally about $25,000 more on top of their pensions to fund their lifestyle. So of course they ask us, well, where should we take this money from? Well, that's what we want to figure out for them. And what makes the most logical sense and what is the impact to both their tax savings or taxation throughout their lifetime and the estate size for their children in the end. So if we look at it, of course, these clients are very fortunate. I recognize that in this example, they are fortunate clients. Not every client does have the ability to, have surplus cash flow and have such a tax or savings problem. So very fortunate in this case, but we do want to look at, what is the most efficient way to save the money on tax and also help them accomplish their legacy goal of leaving a larger estate for their family down the road or for charity. So 3 options here for them. So draw down on the non-registered account, which is often what people think of first. Well, I'm just going to defer my RSPs till age 71. I'll use my non-registered cash, the money in the savings account. I'll use my TFSA first. That way I'm not getting taxed on it. And I'll defer my RSPs for as long as I can. So that's option 1. So the next slide, I'll go through the financial numbers as to how it impacts them overall. Option 2, draw down on the RSPs first. Use that money to supplement their spending needs and take out a little bit extra cash to shift surplus annually to the TFSAs. So we'll focus on drawing down the RSPs more, and some of that extra cash that they don't need will just go and top off the tax-free savings account every year. And number 3, which would be a combination of using number 2. So we're still going to focus on the RSPs first. And then we're going to add in a permanent life insurance, a whole life insurance strategy to maximize the estate and also use it as a powerful tax minimization tool. So we'll look at that and what is the impact overall. Okay, so here would be some of the numbers. So what is kind of the lifetime taxes paid and taxes saved by looking at strategy 1, 2, and 3? So here, starting the RSP withdrawal at retirement time, that would be the middle column, saves this couple about $428,000 in taxes throughout their lifetime. So I don't know about you, but that is a very nice tax savings for this couple that I'm sure they can do a lot more things with than leaving it to CRA by just doing some different planning. Same financial resources, just different focus as to how they're starting to take the money out can have a big difference to them overall. And then the third option was the strategic one, which is what I call it, which is using also a tax-exempt whole life policy to shelter some of that additional cash that they don't need and grow their estate and minimize the taxation along the way. And overall, that saves them $794,000 in taxes throughout their lifetime and still leaves a nice healthy estate in all the different situations, which would be what I'll talk about on the next slide. So considering that they also had the goal not only of saving money in tax, but making sure that they they left a large legacy for their family or for a charity down the road. So we want to look at, are they going to leave that legacy behind? So option 1, hey, let's defer our RSPs as long as possible. Yes, they're still going to leave $4.16 million in the end for their estate. Very, very, very healthy number. But can we do better than that? So yes, if they want to start their RSP withdrawals early, they're leaving $4.4 million in the estate instead, and having an increase of $266,000 in their estate. So again, just by changing that one little thing as to how we're going to draw down these accounts, it generated $266,000 more for their beneficiaries in the end. And of course, the third option is, well, what happens if we, again, focus on which accounts we're going to draw down from and use a tax-exempt whole life policy as a tool in their estate to grow that value down the road. And that creates nearly $800,000 more in the estate by saving them money and without compromising their lifestyle along the way. So again, nearly $5 million. I'm sure their beneficiaries would be happy in any of these situations, but why not leave more if you can, and if it doesn't impact your lifestyle, and if it saves you money along the way? Again, just by doing a couple of these little things can make a huge difference in the end. So that is all of the tax strategies. Of course, this slide, we are looking always to do, comprehensive financial planning for our clients to make sure that we truly understand what their financial situation is, what makes the most logical sense. As I did mention earlier, it depends. It depends on what your needs are, what your cash flow is, what your retirement resources are, to come up with the right strategy that fits for your overall situation. So when in doubt, reach out. Got a great team here to look after those needs and make sure that we're giving you the right advice that is customized to your situation. And that ends on some questions. So I know Clinton and Kevin have been monitoring the chat along the way. I'm not sure if they have any questions at this point in time.
We tackled a handful of questions, particularly on YouTube, and we just responded in the chat. But we do want to leave time for other folks. You can chat, mark it down in the comments. We'll pull it up now to answer any additional questions you might have. I will mention that if you prefer not to ask a question from the audience, you can always contact us directly, whether you reach out to Kevin, myself, or Adam, or if you prefer, you can always hit the link that's in the slide there, chatwithclintonkevin.com. Another way you can reach us. We're certainly trying to make ourselves available for anyone that does have a question, whether they want to ask it in front of the group or whether they prefer to do that offline. We're definitely more than happy to help. At the moment, no questions coming up, so we'll give it another second or two to see if we do get any other questions. Anything you wanted to add, Kevin? Any parting comments here?
All I would say again, we have answers to most of the questions you probably come up with, but if not, we have a YouTube channel which we've done a variety of different videos on, which may be able to answer some of your questions there, or you can look at our Facebook page. We may have some of the answers for some of the things there if you don't want to ask direct questions now. But again, as Clint said beforehand, if you can, we're more than happy to do it right here. If not, by all means, get in touch with us at our website, and we are more than happy to either one of the two of us or Adam answer whatever you can come up with.
Yeah, we had a couple of questions here, Adam, coming up, so we give people time and they fire away, which is fantastic. So the first one is from Kathy, and the question, and this, I'll just read it out. Question: what about segregated funds? So I had a question about segregated funds.
Okay, that is, well, thanks, Kathy. That is a bit broad when it comes to segregated funds, but again, it would be a financial resource that we look at. Depends if it's non-registered, depends if it's RSP or TFSA. A segregated fund can hold any of those. Instead of just being a regular mutual fund, it just has an insurance component attached to it. But it doesn't necessarily have a tax shelter like a whole life policy. It's just the insurance world's version of a mutual fund, essentially, with some slight benefits to it on the life insurance side, which we could get into another day. But hopefully that addresses the question. If there is something more specific, please follow up.
Well, I appreciate it gives people a general question there about how segregated funds work. We had another question here on that life insurance theme. I'll read it out. How does whole life, talking about whole life insurance here, reduce tax during your lifetime? So you have an option there, how to reduce tax kind of for the estate. They're asking how to might reduce tax during your lifetime.
So I'll try not to get overly complicated and long-winded on this one, but the goal is we look at usually a policy that grows in value over time. So instead of that investment growth earning in a non-registered account where that investment growth is taxed every single calendar year, compounded, taxed, all that growth is now sheltered inside of a policy, and all that growth is tax-free inside the policy. So maybe you're still getting 5% return inside that policy. That 5% is tax-free growth. So now it's more and more being compounded versus having to pay tax on that every year on the investment growth. So that's the very quick basics on it as to how it would help with tax along the way.
Okay. Well, and another question here, Kathy, thank you for the follow-up, asking, where do you buy tax-exempt whole life insurance policies? I'm going to give you that softball, Adam.
I love softballs. Well, we can gladly help you out with that. I am fully insurance licensed, so here to help as part of the team, so we can gladly explore the options to see what would be the right fit, what product, what premium, what your goals are, of course, to make sure that this all ties back to your financial situation and what goals and objectives you want to accomplish in the end. But yes, just reach out. We'll gladly help you out.
Perfect. And I appreciate the questions. We got a couple more here. This one from Karen. Should you worry about having a mortgage in your retirement, or should you use your non-registered money to pay off your mortgage?
Here's where I get to use my favorite answers. It depends.
We need a hard and fast answer.
I have to emphasize that.
I like playing the gray.
Yes.
It does depend on what the interest rate is, what your view on debt is. If it bothers you, if it causes you not to be able to sleep at night, that's obviously an important factor. We want to make sure that you do have the peace of mind going into retirement. I generally don't consider a mortgage being as bad debt necessarily, right? It's a good debt. It's got an asset that's hopefully growing in value, decent interest rate. So the rule of thumb is if you can earn more on the investments than what you're paying on the mortgage, then it might make sense to leave the money invested. But again, there are a lot of variables to that. Certainly reach out just so we can have a chat and ensure that we're giving you the right advice. How does it fit into your cash flow? Some people do find a mortgage payment being a struggle in retirement time on top of their lifestyle. So again, it is different for everybody. Trying to answer the question as best as I can, but when in doubt, just reach out. We can have a chat.
And I have to. Oh, I'll jump in here, Kevin. I was going to have to give us a plug. Kevin and I do quite a few YouTube videos on different financial topics. We did cover one about investing versus paying off debt. So I'd highly encourage you to go to the YouTube page. You can watch that video, investing versus paying off debt, and it'll cover what Adam just mentioned in more detail to help give you a more nuanced answer to that question. What were you going to mention, Kevin?
Yeah, and Adam had mentioned that one of the key rules is if you're earning more on your investments than you're paying on your debt, that's always a good sign. We should emphasize that that's probably more of what you're earning in real terms as opposed to nominal terms. So, I mean, if you're earning a 4% interest rate, but after taxes, if you're only earning 2% and your mortgage is 2%, that may be something to see. So one's earning more than the other, but we want to look at real terms compared to nominal.
Correct.
Okay. Yeah, and again, I will highlight the YouTube video there. It covers it in far more detail, a good 10, 12 minutes just on that topic. Another question here, going back to life insurance, Adam, does it make sense for seniors, and in brackets they qualify, it's 71 plus, to start a whole life insurance plan?
It could. I'm going to say depends on how far past 71 plus we are. I've done a couple in the last year or two where a couple is, between 70 and 75, and it's worked out rather nicely for them from a numbers perspective. So I would say it certainly can work. It does depend on, obviously, qualifying for the insurance, depends on health and history, and, what amount and how it kind of ties into the overall financial picture and goals. But yes, it most certainly can work. The older you get, the more challenging it is to kind of compare it to other options, though.
Okay. All good questions. So I appreciate everyone chiming in there. And I should mention, guys, we did have some positive comments as well. Quite a few folks are asking where they could find the video again. It will be on our Facebook page and our YouTube page. Quite a few compliments. Adam, we had one here saying it was a very good presentation, particularly noting the tax reduction strategy. So thank you for that.
Excellent. Thank you.
Yeah, and we haven't had any more comments pop up, so I think that would be a good place to end it. A reminder, if you do want to ask a question offline, reach out to any of us directly, or you can always go to chatwithclintonandkevin.com. We're happy to see you there. Kevin, I'll throw it to you. You get the last word here.
I do. Well, no, it's a topic that's very timely and is usually one that everybody should take a look at because we all are aging slowly but surely. We all are going to need to know how our retirement looks. So figuring out the best way to deal with it. And I think, as Clint said at the top of the entire scenario for the presentation, taxes usually tend to be the biggest expense that you have in retirement. So knowing how to handle them is definitely something you should take a look at.
Leave it to Kevin to end on a positive note. We're all aging surely and gradually, or whatever the comment was there, but you certainly mentioned
exactly.
it. I spoke too soon. I apologize. We have one more coming in here. The question here from Penny, is there income splitting for couples? What is for individuals? I'll pull it up here so you can see the wording from Penny. Is there income splitting for couples, and what about individuals? I believe that's the thrust of the question.
Yeah, I can't say that there's income splitting for individuals. It's a good question, and it can be more challenging to come up with ways to save money on tax as an individual. Besides using RSPs, charitable donations, some of the other strategies we chatted about, as for actually splitting it and trying to minimize tax brackets between two people, it's not overly possible with an individual. Not that I've come up with yet.
Yeah, so
but I'm always on the lookout.
Yeah, we talked about the strategies earlier. You mentioned the splitting strategy, I believe strategy number 1, and also when you went through the RSP meltdown strategy number 4. In both cases, part of the reason we encourage folks to address it a little earlier is just if you have two folks earlier in retirement, you can take advantage of those splitting strategies. If you wait a little longer, well, it's a higher likelihood someone might pass away and you might lose the opportunity for income splitting. So unfortunately, Penny, at the moment, it likely only applies to couples, but who knows? Maybe the rules will change and we'll get a few more tax perks for individuals as well. Good. Well, I appreciate all the comments. I think we'll end it there. And thank you for chiming in. If you do have additional questions, reach out to us or chat with ClintonandKevin.com. We're always happy to help out. Everyone enjoy the rest of their evening. Take care.
Take care.